All right, hello everybody, and welcome to our 2024 annual business meeting. We have a lot that we are going to cover today. We're going to talk about a client and how they're doing with their real estate. We're going to talk about the FinCEN registration. We're going to talk about my daughter's graduation loan. We are going to review some tax returns together. And then I have some questions. So I wanted to go ahead and get started while we wait for more people to join. So the first thing is everybody can share what they've any special news, anything newsworthy that you want us to know, you can post in the chat. On my end, I am going to share my screen for my daughter's graduation. She just graduated from Duke University about 10 days ago, Mother's Day. So just, I'm gonna start scrolling on the pictures while we wait to hear from others. So she did a Bachelor of Science in Econ, and also she got an entrepreneurial and innovation certificate. So can you guys see the screen on the pictures?
Yes, we can. Congratulations, Abel.
Thank you. Thank you.
Congratulations.
Thank you. So that's her there. That's all of us. Oh, so let me tell you guys the story of what happened with my husband. I'm not sure if you guys heard that Prince Harry and Meghan Markle had gone to visit Nigeria. I'm not sure how many of you heard that, but my husband's nonprofit was one of the ones that they visited. So he had to be in Nigeria the week before the graduation. And they were coming on May 10th. And her graduation is May 11th and 12th. So he literally just welcomed them in Nigeria, got on the plane, and flew all the way here on Saturday and drove down to North Carolina to make it for her graduation. So the sacrifices that parents make for their children. So I just wanted to highlight that. So seeing him in this picture, it looks like everybody was there, but the whole behind the scenes stories is usually, very interesting to say the least. So I'll just keep going through the pictures. This was her getting her entrepreneur certificate. Yeah, innovation and entrepreneurship. So Trinity College of Arts and Sciences. All right, this was her. She wanted us to go to the Duke Gardens and hang out for a little bit before going to lunch. These are all her cousins. One cousin that came from South Africa, and then the other little cousins. And, oh, okay, so this is all of us. And just scrolling through the pictures. As you can see, when Nigerians do things, we do things as a group. So this is a lot of friends and family that flew from all over to come and support us for the graduation. All right, this was us doing dinner. And she took us to an Indian restaurant in Durham, which I was worried about how Nigerians were going to handle Indian food, only to realize that it's about the same food, and it was really good. And as you can see from the plates, everything got finished. So this was May 11th, so the day before. Now this is the graduation day on May 12th. And this is us out there in the sun. And this is me and her. And yeah, this was after she got it. All right, this is all of us. So if you guys see the sashes that we had on, we made those from Nigeria. So that had her picture on there, the Nigerian flag, and class of 2024 with her name on it. This is her and her dad and other family members. Oh, this here is, for those of you that don't know, this is Letitia. So most of you have interacted with Letitia every now and then. Letitia used to work for me here, still works for me, but now lives in um North Carolina. So she actually drove down to come and celebrate with us. And this is us. Okay, so I think that's it. These are all the pictures. So I'll stop sharing. Does anybody else have anything else they want to okay, thank you, thank you, thank you. Sam, you're asking a question about revenue share. I don't know what that means. Can you explain what you're trying to ask before we get started? Thank you guys. Thank you so much. All right. So the next thing that I want to go over is kind of a the recap. I was talking to a client today, Nigel. He will be on with us next week. And he brought up some really, really very important points on a deal that he was working on. So I told him that we're going to discuss that on the call. And if you guys have questions, you can post it here. I'll send it to him, or he will be on next week to address those questions. So I'll share my screen and just give a brief summary of all that has happened. So pretty much Nigel bought a property, a 3-unit property in Baltimore. Yay! Congratulations, Brian. And sorry, Nigel. And he bought it in Harlem Park, 21217. The last one that he got was in Reservoir Hill. So I asked him how he found out about the property, and he said that he was looking at properties in Baltimore and was introduced to it by networking. So it's very important that we understand the power of networking. Purchase price was about 113, and he's going to put a 108 into rehabbing it. Doing it with a hard money lender at 14%. Ouch. We'll talk about that later. 90%, the hard money lender is funding 90% of the purchase price and 100% of the rehab. So he only had to put down about $20,000. And then after repair value is going to be between 390 and 415. It's going to take him about 6 months to complete the rehab. And then this is going to be a long-term rental with rental revenue anticipated at $5,000. And it is going to cash flow at about $1,500. So I asked him to come on because I felt like there was a lot of nuggets that came out of this deal that I thought that a lot of people would benefit from. One thing was I love the whole power of networking. Two, being able to get the kind of financing that he got for this property in this market. Two, this is this is a 3-unit, property, and being able to cash flow $1,500. And when he refinances in 6 months, he's able, because you're going to refinance at what, 70% loan to value, he's going to be able to pull all his money out and still be left with about a $1,500 cash flow every month. So this is a really, 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 really sweet deal. He would be on next week to talk to us about it. So let's talk about some of the tax things that I looked at as a result of everything that he did. So the first thing is, because it is a long-term rental, he is not going to be able to get the benefit of the short-term rental. If your income is over $150,000 and you spend more time at a regular job than you spend in real estate, you are not able to claim those losses. So he does understand that for this particular deal, even though it's a very good deal, it does not really have any tax impact because most of the losses are going to be trapped as suspended losses. We also talked about the possibility of maybe him adding on short-term rental in order to get the short-term rental losses. And so we went over the requirements to get short-term rental losses. That short-term rental has to be an average of 7 days or less of rental time. And then at least 100 hours for the year working on the property. So not just what you do with the management. Now, I have another client who asked me, does the time that you spend driving to and from the property count? No, it does not count. They also asked, does the time that you spend looking for properties prior to purchasing, does that count? It doesn't count. But the rest of your management time, and if you have a property management company, that time needs to be more in order for you to claim the short-term rental loophole. And then also you need to be providing incidental services, you know, whether it's meals or daily cleaning, almost like a hotel, for you to be able to claim the short-term rental loophole. So if he does qualify for the short-term rental loophole, then we are able to accelerate depreciation and be able to take depreciation in the current year that would help to reduce his taxes. Another thing that Nigel did that we kind of talked about was because he needed some money to do the rehab, he had to end up taking money out of his Roth IRA account. So I informed him that next time, before he makes that kind of decision, he does need to let me know, because the strategy that we could have utilized is, instead of taking out money out of the Roth IRA account, yes, he's going to not pay, you know, the regular federal and state taxes, right? And he's only going to pay the 10%. But because, you know, we did not discuss it ahead of time, we could have utilized a strategy where he can partner with his Roth IRA to have purchased this property. So there was no need to take a distribution from the Roth account in order to do this deal. His LLC could have simply just partnered with his Roth IRA by moving that money in the Roth IRA account into self-directed IRA funds. He can partner with his IRA. So you're able to partner with your Roth IRA. You're able to partner with your traditional IRA if they're in self-directed IRA accounts. The percentage of ownership just needs to stay the same, right? So if it's 70-30-30, then it needs to be 70-30-30 throughout the life of that property. It's not something that you can buy first, then maybe have the Roth IRA transfer the money, or the Roth IRA buys, then everything, the percentage needs to be the same from the beginning. And then the other thing that we discussed is possibly maybe looking at whether he can use the Roth IRA in the next deal. But as we were talking about that, we realized, oh, wait a minute. That may not work, because if it's going to be the short-term rental loophole, now that the losses that he could have otherwise claimed are now trapped in the retirement account. So that's why it's important to do these kinds of analysis, to make sure that you're talking with your accountant, hey, before you make any decisions. That way, we can look at all the factors. Another thing that I talked to him about was, with the hard money lender being 14%, I know that there's a lot of people who want to get into real estate, don't know how. Nigel has done such an awesome job. Like, he's been knocking it out. Like, he bought a 3-unit, I think, last year. He bought another property the year before. So his goal of getting into real estate investing, he is achieving it. And I told him, hey, Nigel, I'm sure that there's some people who may want to partner with you to save money on this 14% in exchange for, like, looking over your shoulder. Right? So if it's something that you're interested in, please feel free to post in the chat and I'll get the message out to him. So I'll pause now and take any questions that you guys may have on the two things that we've covered before we move on. And then I'll also look at the questions that are here. Okay, Nigel say is on listening. So if anybody is Anybody has any questions for Nigel, you can either say it out or post it in the chat. Or anybody has any comments, we can look at those before we move on. So, Raymond, do you want to share with me the tax savings strategy that you've heard me discuss so far with this property in Baltimore? What is one tax savings strategy that we can utilize when it comes to, one, dealing with your IRA, two, short-term rentals?
Was that question for me?
Yes, sir.
What, can you repeat it again? I'm sorry.
Okay. Based on, because you wanted to discuss tax saving strategies, and I was asking based off of the items that I covered already, what are two tax saving strategies that I covered when it comes to purchasing long-term rentals?
Well, yeah, you talked about the depreciation, right? Being able to depreciation for when you have a sale of a property, but not so much if you have the rental, that you can benefit from tax strategies, tax saving strategies. If you were to flip a property, it sounds like there's more opportunities for tax savings than if you do the buy and hold.
Yes.
Okay.
And in addition to that, not taking money out of your retirement account to do deals, but you can partner with your retirement account to do deals. That way you avoid having to pay, first of all, the early penalty for withdrawing money from your account. And plus, if you do it with a traditional IRA, the federal and state taxes. And then also we discussed the short-term rental loophole of being able to buy properties and then doing the short-term rental loophole. Average of 100 hours a year, 7 days or less in bookings. Each booking has to be an average of 7 days or less. And you provide incidental services. With doing that, you are able to accelerate depreciation on your short-term rental.
Now, Aber, isn't there a way where if you have, isn't there a self-employed IRA or a different type of IRA that allows you to pull money out of it for an investment and put it back with the profit or something like that? I'm trying to remember. I thought I heard you talk about that before.
Yes, you can actually invest. You can invest with your IRA. You can lend someone with your IRA, but you can partner with your IRA to do deals. It just needs to be done at the beginning. Like you can't go back and try to play catch up. It has to be done at the beginning. All right. Edith, do you want to explain what you mean about the new rules for realtors as of July, no longer direct commission split with buyer's agent?
Can you hear me?
Yes.
Okay. No, what I was talking there was a lawsuit brought forth, and now normally if you are the listing agent, you can put in your document that you can share a percentage of the commission with the buyer's agent. We can no longer do that directly. Yeah, what happens is you can explain what could happen with the sale to your seller, but you can't compel them to offer a commission unless they want to. So it's going to change things in the real estate areas. So just be aware of that.
Absolutely. Wow.
Because because the buyers now are going to have to come up with their buyer commission that they negotiate with you, basically, rather than assuming that the seller is going to pay for it. So that's more money that's got to come up front for buyers as they go through their transactions.
Oh, wow.
So I just wanted to bring that up to the group since,
Yeah, I know that there's been with all those lawsuits and stuff that happened. I knew that there were changes coming. I didn't know exactly how that was gonna play out.
as of the new July, we can't automatically assume that any longer.
Hmm. Okay, so that means, I mean, more as these things come out, there's usually where you now have to figure out all the alternatives for getting things done.
Yeah, the buyer's agents have to realize where they have to come up with that talk with their client, because we got to know where the money's coming from if we're going to represent them. Because the
Yeah,
listing agent and the seller does no longer has to, provide that support for you.
wow. Okay, so Kimberly, I acknowledge you. I'll get you soon. Let me and Corey, I see you. I'll get you soon. Let me take a couple of questions on here, then I'll open it up. If you are the co-founder of a 501c3 and currently sit on the board, can you deduct expenses used to pay for the operations of the nonprofit? Yes, but the ideal situation is that you contribute that money to the nonprofit and then let the nonprofit incur its own operating expenses. So really the question should be, can you contribute to a nonprofit where you are the co-founder? The answer is yes. So it's better for you. It's just like business, where you say, if you're a business owner, can I deduct business expenses that I pay on my personal credit card or personal debit card? It's better for you to make the contribution to the business and or the nonprofit, and then let the nonprofit or the business incur its expenses. That way you're not having to deal with commingling or, like an audit comes up, then now you're having to present personal bank statements and substantiation rather than making the contribution. So if it's a business, you're making a capital contribution. If it's a nonprofit, you're making a charitable contribution. So by doing that, you're able to get the deduction rather than having to pay for it directly on your own.
Okay, yeah, that makes sense. In addition to that, Abir, so what if you have my nonprofit deals with science, technology, engineering, and math. So
Mhm.
what if I had a project where there's a property and then there's a nonprofit component to it where I have like say I have students doing the install of the smart home technology within the home. I'm trying to figure out, is there a way for students to benefit from understanding more about real estate from the perspective of science, technology, engineering, and math? And so I've been contemplating, is there a way for me to do those activities on the nonprofit side and on the for-profit side with real estate?
Yeah, both can always partner. Remember that for-profit and nonprofit or not-for-profit does not mean that there's no profit. It's a matter of who's getting the profit. With a for-profit, the partners, which is most of us, the partners, the owners, shareholders get the profit. But then when you're dealing with a nonprofit, the profit does not go to the president or vice president. It stays with the not-for-profit. But in terms of the activity, it really could be the very same activity. It's just a matter of who keeps the profit at the end. So it depends on how you want to engage the students that are coming from the nonprofit and whether or not there's going to be some level of compensation or donation that goes back to the nonprofit for the work that it does. But we can talk about that when we get to your business meeting.
Okay, yep. But what I was thinking is that there may be grant opportunities on the nonprofit side that I could use to do a real estate transaction with the students and everyone involved in it. So we'll talk about that more when we have that meeting.
Okay, absolutely. All right. Okay, somebody wanted me to elaborate more on partnering with my IRA. Usually I like to put you guys on the spot. So who here wants to repeat what they heard me say about partnering with your IRA? The first question is, can you partner with your IRA?
I think the answer is yes, but here's the tricky part with me because I have I have that thrift savings account with the federal government, which probably has a bunch of restrictions of things that I can't do. So I would like to be able to do that, but I'm not sure if I can do it with
Okay,
a TSP.
absolutely awesome, awesome question. I'm glad you brought that up. So yes, you can partner with your IRA, but it cannot be the IRA where you still currently work. It has to be moved into a self-directed IRA account where you have a custodian, then you partner. So if you have like a regular retirement account that's like with Schwab or T. Rowe Price or your regular job like the TSP, you're not able to partner. But if it's a firmer job that you're in or a firmer retirement account that you have, yes, you can do that, but you would need to transfer those assets to a self-directed IRA account or a 401k and then partner with that. But in order to do that partnering, the ownership needs to stay the same from the beginning. So if it's an 80-20 partnership, you 80 and your IRA 20, it needs to be the same throughout. It cannot change, like in the middle, let's say IRA runs out of money or you run out of money, then now you're changing the percentages. It needs to be the same throughout. And you can even, one of the discussions I was having with Nigel, you can partner with your Roth IRA and your traditional IRA. So on title, we have 3 owners. We have the business, we have the Roth IRA, and we have the self-directed IRA, and all 3 are partners. Another strategy that you could use if you have an IRA that is like, like with Raymond, where it's still at your job, you can borrow from it because you can borrow up to $50,000 from your TSP account. Borrow that $50,000, put it into an LLC, an IRA, and then use that money to do the deal and do the partnering that way. The only thing is that is limited. But if you have a spouse, you do 50, they do 50, that's $100,000 right there. So there's several ways that you can get this done if done the right way. Okay. What if you use the same agent for both selling and then purchasing the next property? Edith, I don't know if you have the answer for that, based on, what.
Well, the first part of it is, if you're working with an agent that's selling your property, you have the listing agreement with that person. There's no impact because you're going to negotiate your commission. Now, when you go to buy the purchasing of the next property, you have switched now to being a buyer, and so it's your responsibility to pay your buyer's agent unless you can come up with a negotiation with the new seller. That's how I interpret that question.
Yeah, so unless it's, unless you let them know that, well, I don't know. Is there a limit isn't there a limit where it's 6%? Like, can you say, oh, okay, I'm gonna do 9% or something
You can do whatever you
on
want.
sale, and then you do it free on the next one?
You can, no. You can negotiate the commission based on what you and the listing, the seller wants to negotiate. So if the seller wants to give you 9%, they can give you 9%. The way I'm interpreting this question, she says, then the next purchasing the next property. My assumption is that person, the first person, doesn't own it, so you're going into a whole new negotiation.
No, she means the same agent. So what she's saying, like if you have a selling agent on property A,
right,
that they can be the purchasing agent on property B.
But
so if I'm able to pay them more on property A, that way I don't have to deal with paying them an agent fee on property B.
As long as they have written it out in their contract, that's okay. How they're going to do it. But there's no negotiation on the second deal. If you're talking about the same one, that's fine. They can give you 9%, 6%, 10%.
Yeah.
It's whatever they negotiate. It's just that they don't necessarily have a new one coming from the next, property, a new commission.
Yeah. All right, so next, Cornelius brought up a point. Cornelius is also a CPA and that works with us. He talked about, do we consider UBTI? UBTI is unrelated business taxable income. That would apply to the question that Raymond asked about the nonprofit and also apply to the issue that we were discussing about partnering with your IRA. If you have any kind of debt financing involved when you are doing this partnering, then yes, you will do UBTI. The suggestion that I was making to Nigel and to others is that by partnering with your IRA, you may not need to go out there and borrow money. So in doing that, you avoid the UBTI. But if there's any kind of debt financing or the nonprofit is engaged in activity that is not directly tied to its nonprofit purpose, yes, you may have UBTI. And that's why I told Raymond we need to talk offline, because we need to make sure that the tax exempt purpose of the nonprofit directly tries to, helping people in the area of real estate and maybe the specific area of STEM in real estate, then it may not be UBTI. But if it's something that's completely unrelated, maybe like you set up a nonprofit, let's say to feed animals, and now you're doing real estate, then if it doesn't tie to the tax exempt purpose, whatever that income is will be subject to UBTI. So it's kind of like the same principle, the nonprofit engaging in something other than its tax exempt purpose or using loans in an IRA to purchase property. Both are subject to UBTI. Okay. All right, UBTI is unrelated business taxable income. So the IRS says that if you end up engaging in any activity that doesn't have to do with the reason for why that business is set up or nonprofit or IRA is set up, you end up having unrelated business taxable income. So they believe that the IRA is set up for passive investment. By borrowing to do deals, they say that IRAs are not in the business of borrowing money to do deals, so they will tax it, which defeats the whole purpose of doing stuff in your IRA in the first place. A nonprofit is supposed to exist for a specific tax exempt purpose. You turn around and you start doing deals like purchasing real estate and all that. If it's not tied to your tax exempt purpose, the income that it generates is no longer non-taxable income. It now becomes unrelated business taxable income. Okay. Kimberly, I'll take your question now before we move on.
Okay, so I wanted to inquire about the percentage from the IRA, using it as a business, partnering with your IRA.
Mm-hmm.
So does that affect the income that would be received?
Yeah, it will still be split. It's going to be split based off of that percentage. So if it's 80-20 and you make $1,000, that means that you as the individual, you're going to get $800, and then $200, 20% is going to go to the IRA.
Okay.
Yeah. So that's why I said everything literally needs to stay the same throughout the life of that property or the life of the partnership.
Okay.
Mm-hmm.
Thank you.
You're welcome. And Kimberly is also another tax preparer of ours. Can you borrow from an IRA for an extended period? Yes, but I'm glad you brought up that question. You know what happens sometimes? When you borrow from an extended period, sometimes the custodian may deem it uncollectible and they don't write it down. Please listen. This is very important because a lot of people have gotten caught up in this. They do not write down the loan. They treat it as a distribution. Now you end up having income. I'm going to tell you the strategy that we've used for a couple of clients on how we handle this. But I want you to understand that the longer that you keep that loan out there without satisfying that promissory note, the custodians will treat it as a distribution to you. So now you're getting a 1099-R on a loan that you haven't gotten back. So what we do is we tell people, if you know that it's going to be for an extended period, maybe what you need to do, because you know that you're already going to get that 1099-R from the custodian, would be to turn around and have this person, when they make the distribution, make a contribution to your business and have your business turn around and do a new promissory note with the borrower and then write it off as bad debt. We've had clients who have lent money in their IRA, the person didn't pay back. Now they have this 1099-R where they have to pick up income, but they're still not able to write off the bad debt because it was done in the IRA. But when that distribution happens, you simply execute a new promissory note, because then you can write off that promissory note as bad debt. Of course, you need to meet all the requirements of making sure you've made attempts to collect the money and all that, and can't. That way the 1099-R is being washed with the bad debt expense that's coming from the business. Otherwise, you're going to have this income you're paying taxes on, and you never even collected the money in the first place. Okay? All right, last
Wait,
question.
sorry, that just scratched my head, but you can go ahead. I'll come back to it.
Okay. Can you explain the backdoor IRA for those earning over 150? Yeah, very simple. So instead of contributing, where you can't contribute to a Roth and you can't contribute to a traditional, you can contribute a non-deductible amount to your traditional IRA. So you're already paying taxes on it anyway. But then what happens is later on, you now roll it over from the non-deductible traditional IRA into the Roth. That's why it's called a backdoor Roth, because it starts out as a non-deductible traditional contribution, and then later on you roll it over into the Roth account. Okay.
How long do you have to do that?
I don't think there's a time limit and when you have to when you're able to roll it over. How to set that up, you can do that. Some people do that through their jobs, or you can just do it through a regular bank account. You just set it up with a regular bank. With the solo 401k, no, because the solo 401, I'm glad you asked that question. Solo 401k, SEP, Simple, those kind of retirement accounts, unfortunately, you can't just put money in there. It has to be based on what you earned. Contributing money into a solo case, SEP IRA, Simple IRA that is not based on your earnings is a disqualified transaction, and you will be charged a penalty and excise tax for having contributions in there that is not based on income. So thank you, Patricia, for pointing that out, because that's very important. You can't do a backdoor Roth IRA with a solo case, SEP, anything that is a business retirement account, because that is based on the earnings of the business. Okay. All right, moving on. We do have Corey on, who is a loan officer. I've been working with Corey for such a long time. Wonderful, wonderful friend. So I asked him to come on because he does have some loan products that I wanted us to look at. And the reason why we got talking about this was because we have a lot of people where the issue they're having with the deals they're doing now is the financing. As you can see with Nigel's, the financing was at 14%. And I'm not even sure whether that included points or not. So it's becoming expensive to do deals. And so we were looking at what are the various options that we have. I think there's going to be a client that's coming on either next week or the week after who was able to work with Corey to be able to get a loan to close on his deal when he thought that he wasn't going to be able to make it. So I'm going to share a screen and then just ask Corey to share with us just for about 3 to 5 minutes, because I did have other tax things I wanted to cover. But
Great.
welcome, Corey, and please
Thank you
tell
so
us a
much.
little bit
And
about what
I
you do.
appreciate, yeah, thank you so much. Just to give you a little background, I have been in the mortgage industry for over 20 years. I'm the owner of Best Loan Choice. We're a mortgage lending company. We've had Best Loan Choice has been around for about 10 years. We have a lot, I have a lot of background in structuring loans for investors. I can do the residential side, but I do have a lot of experience on the investor side. Right now, the market for investing is wide open. So there's a lot of different options. There's a lot of different companies that are in the market that weren't in the market years ago. So at one time, it may have been that just the guy down the street was the only person that could give you funds, the local guy down the street. But that's changed a lot. And now there's companies all over the country that have financing available. The other piece to it is that there's a lot of opportunity now for leverage. If you could go down to the next slide, keep going. I'm going to start out. I'm going to go through this quick. I know I only have a few minutes. The key right now that I see when you're an investor is your leverage. Okay. So you may have somebody who gives you money, or not gives you money, but lends you money, that's a local person. And that's good. And that can be quick at times. But the issue with that sometimes is that they're not going to be as flexible with your loan to value on your acquisition, for example. So we have investors that will go up to 100% on the acquisition if it's a good deal with the ARV. Typically, most of the deals I do with experienced investors, we're going up to 90%. We're typically only looking for most people, unless you're a first-time investor, 2 points is usually the max that we usually charge. We usually have competitive rates, sometimes even like around 9% with 2 points with somebody who has experience. We're also doing ground up construction financing. There's a lot of avenues now where you can, if you have a lot, you can use ground up construction financing that we provide. Okay. The other piece is a lot of folks who are getting started, they want to cash out, they want to pull out equity from another property. Okay. They want to pull out, whether it's a HELOC loan or a home equity loan, they want to pull out money from properties that they own free and clear, or they have equity in, and use that to purchase new properties. So we can go over that. There's a lot of avenues right now in the permanent financing. I could do a whole webinar just on this, so I'll keep this in the short version. But as you've probably heard, there's things called the DSCR loans that are based on the rental cash flow. But sometimes you also have to be aware of prepayment penalties that may be long prepayment penalties that might be 3 or 4 years. You have to be careful because the market may change. So if you're getting into permanent financing that has prepayment penalties on your investment property, just be aware of what's involved on those penalties. Okay. And then I think commercial, we have some options for that. I won't get into that too much. This is the last thing, lease to own qualification program. We have a lot of landlords that would love to sell to their tenants. And this is a good program because there's a lot of demand for real estate, not a lot of properties on the market. So for a tenant, it's a real win because it may be hard for them to go out on the market and purchase a property. But for you as a landlord, if you know this tenant, if you don't have to go through putting the property on the market, if you don't want to deal with the real estate commissions, it may be a much easier avenue just to sell to that tenant. The question with that then becomes, can the tenant qualify? As we know, a lot of tenants, the reason why they're renting and not buying is because they have credit issues or they can't qualify. So what I do is I work with landlords where it may be a year in advance, a year and a half in advance. We're already having the conversation and looking at that tenant. So you can strategize a year from now, maybe that tenant will be ready to buy your property. And you can put that into a tax strategy, Abiri, where maybe it turns into someone that usually flips, but maybe they want to work more into, not getting the short-term capital gains, but the long-term capital gains tax rate because they're able to put the tenant in there for a year of leasing. something of that nature. So I don't want to get too much on the tax side. She's the expert, but I think the financing kind of comes hand in hand with the tax strategy. So
Yes.
I'll leave,
And that's
I'll
why
leave
we're
it at
working closely together to make sure that we're able to handle both. If you can put your contact information in the team, we are going to schedule a webinar where we just deal with finance. And I just asked them to come on to be able to explain the different loan programs that he has. So right now we're switching, we're going back to tax. I am going to review an actual tax return. And I'm going to let you guys know how we review, because sometimes, I don't think, like, sometimes where we say, a day in the life of, I don't think everybody truly understands sometimes the way that things work. So, like, I may not have an appointment. So it's possible that you could call the office and Ibarra doesn't have an appointment, but it doesn't mean that she's not busy, right? Because I review every single tax return that is prepared by this office, even if the person is not on my team. So you may not be on my team. You may be on David's team, or you may be on Namdi's team, or you may be on Martisha's team. You might have Israel preparing your return, or Camille's preparing. I review every single return. So if you call and you realize that you're not getting an appointment immediately, it's not because I'm trying to avoid you. It's because a lot of my time is spent dealing with review so that I'm able to do proper tax planning. So it's important that we understand that, because sometimes clients want us to be very responsive, but me being responsive sometimes means that I may not be able to spend the quality time that I need to spend on each of your returns to make sure that you are getting the best tax saving strategy possible. So now I'm reviewing one return. I look and I see they have a business. This person has an IRA. They have a single member LLC. They have a multi-member LLC. So of course, the single member, I don't need to review that separately, because a single member LLC is prepared right alongside the individual return. And then the retirement account is going to be separate because that's in an IRA. And we'll look to see whether or not they have unrelated debt finance income. So now I'm going through and I'm looking. And the main thing that I look at is I do a comparison between what did you have in the prior year and this year. So this client, I'm looking at 2022 versus 2023. And theirs is not that much. It's only like a $100 difference between the 2 years. I'm looking and I'm seeing that their rental income has gone up. It's gone from $1,200 net to $4,500 to $4,900. So now one of the things I'm looking at is there anything that we can do to bring down that rental income? So some of the questions that I'll have, and then Namdi, please make sure that you're writing these down. One of the questions that I have is, have we done cost segregation on this property? Because if we haven't done cost segregation and we have net rental income, I want to be able to see whether or not we're able to do that on this return to at least bring it to zero, right? They may not be able to claim the losses if they make over $150,000, but at least we can bring it down to zero. Another thing that I look out for is whether there's discussions that I've had with the client throughout the year, and to make sure that those notes are included. So I usually ask, did I have any meetings with the client throughout the year? Now, a big thing that happened, which you guys need to know about with this client, is that we had a total, no, we don't want you guys looking at the return for confidentiality. One of the things that came up with this return was that we had a total of $50,000 of rental income, but they're saying that they had $70,000 of rental income, and we're trying to figure out why. Now, what we realized was that the property management company had all of the properties on one 1099, but one of the properties is owned by the LLC. So it's very important that when you're dealing with third parties, that you want to make sure that you maintain your entity structure, because these are the things that the IRS could look at, or if you're getting sued or anything, that you're commingling, right? Because a 1099 was issued to two properties that are in their individual name, and then one property that is in the LLC, and it was all mixed up together. It should be separated. There should be a separate 1099 for the LLC, and then another 1099 for the one that is in their name. So just wanted to point that out. So far, all of this looks good. So now the reason why I review the business return first is that if it's a multi-member LLC or an S Corp, it has to go into the individual tax return. They get a K-1 that goes into the individual tax return. So now I'm getting ready to look at the individual tax return. And the individual tax return is where it really matters. I know a lot of people tend to focus a lot on their business return, but if you have a multi-member LLC or an S Corp, where it really matters is your individual return, because you're going to get a K-1 that goes in your individual return. And that's where we're looking to see whether or not you have a huge liability. So automatically looking at this client's return, the one concern that I have is they make over $300,000. So automatically I know that we cannot do much with cost segregation. I want cost segregation that's just going to bring down their liability, but not a loss, because the loss is going to be suspended. The other thing that I'm looking at here is I see a huge $203,000 of income and loss. So what happened was that this person sold one of the rental properties. And because they sold one of the rental properties, all of the passive activity losses that they had in the prior year can now be written off. And believe it or not, it was at least $203,000 of passive activity loss. So for those of you that don't know, when you have a passive activity loss, when you do not, if you have a passive activity loss where you are not able to write it off because, one, you're not a real estate professional, two, over 150, three, the property is not sold, it just keeps getting accumulated, or what we call suspended, until the property is sold. No, I'm not sharing my screen because of confidentiality. I'm just sharing with you guys some tax strategies that we utilize for clients. So in this case, all of the income, the capital gain that they had on this property was literally wiped out because they were able to use the whole $200,000 of passive activity loss against the $200,000 of capital gain. Okay. So in looking at this, I'm just looking to make sure, did we do the calculations right? So now I'm going to the capital gains worksheet, and I'm looking to see how was the capital gains worksheet prepared. One, you need to make sure that you have your purchase price, that you add on your rehab cost, improvement cost, closing cost. A lot of people forget closing costs on your refinance. So make sure that as you are refinancing properties or doing improvements, that you maintain a log and that you're submitting that to us so that we can properly track your basis at the point of sale. We've had clients where they come to us and maybe they've owned the property for like 8-9 years, and then it's time for the sale, and that's when we realized that they didn't have the right cost basis. And when we went back and looked at the prior returns, it was because of how it was set up in the first year. Maybe land was skipped, or all of the improvement costs were not properly added. So those are things that we look at when we're, looking at properties. If you're with us, we review the last 3 years, but if you've had that property for 8 years and the original accountant did not set up the basis properly, it can end up impacting your gain. So make sure, because some people, you end up going from one CPA to the other, make sure that the cost basis and the depreciation report that you have is properly coming over. So in this case, this is a quick review. I'm looking at the sales price, looking at the closing cost. I see the purchase price, and then I see the accumulated depreciation. As most of you know, accumulated depreciation that you claimed before has to be recaptured when you sell the property. So that's how they have the $200,000 gain. So just looking at that, and this looks pretty simple. So I will pause now to take some questions. We're getting ready to wrap up. And I have one more review that I'm going to do, and we are done for the day. Does anybody have any questions just based off of the items that I reviewed now on this return? Okay, moving on, I have one more review to done and we're done for the day. I wanted to make sure we covered everything. Yes, the beneficial owner interest. One of the things that the reason why we're waiting is because the Maryland Certified Public Accounting Board has sent a message to FinCEN to ask them whether or not we are able to handle the FinCEN reported. And so far, we haven't gotten any feedback. Some of the insurance companies are telling us not to do it because it will be the unauthorized practice of law. So we're still waiting. The good news is that we have till the end of the year to get the FinCEN reporting done. The bad news is that some of you are still waiting. But what we're gonna do, I think in the next call or the third one, I have it scheduled. We're actually gonna get a report filed. I heard it literally takes 8 minutes to get it done. So if you have your ID, the name of your business and all of that, you literally could do it while we're on the call, and so that you can get it filed if you want to get it done. But we have till December 31st. So even if we don't hit it in late summer, we can work on it November, December before the deadline. But we're hoping that by then we would have heard from the accounting board, the CPA board, and our insurance company whether or not we're able to do it. Okay, yes, we are going to have a recording and we will send out the recording after we're done. Has there been a ruling by the House relative to reinstated? No, there's still all of that information, with everything that's going on, the additional child tax credit, all of that is still being held up in the House. So we're still waiting on that. All right, I'm reviewing this next client. They have a business. They have 2 businesses. So we're going to look at the 2 businesses that they have. We're going to look at the first one. The first one is an S Corp. Whenever I hear the word S Corp, the first thing I look out for is whether or not there was a reasonable salary. So if you're going from a single member LLC to an S Corp, or multi-member LLC to an S Corp, or C Corp to an S Corp, you need to make sure that you're paying yourself reasonable compensation. What is reasonable compensation? If you had to go out there and hire somebody to do the same exact thing that you're doing, how much will you pay them? So you want to make sure that you're paying yourself a reasonable salary. In this case, I don't see any reasonable salary, and it's okay because this business did not make any money in 2023. If the business made money in 2023, I would have asked the question, why do we not have reasonable compensation? One of the questions that I have on here, I see where they had a deduction for their taxes. So I want to understand what is included in the tax return, because typically S Corps do not pay any taxes. It's paid on the individual return. So I'm wondering why we have $1,100 of tax deduction here when this business does not pay any taxes. So Namdi, please note that so you can give me an explanation of what makes that up. Now I'm going and looking at the second return just to see what's going on. This one here is a multi-member LLC. So I'm looking to see, that means it's going to flow through to the individual return. Same thing, I'm looking at what happened between last year and this year. It's kind of reasonable. I don't see anything out of the ordinary. I want to make sure that my staff, we usually require that they reconcile everything, the numbers that you guys provide to us, all the way to what we have on the return. We need to be able to show how the numbers that you gave us and the numbers that we have on the tax return, what the difference is, and that we've properly accounted for that. So I see that a reconciliation was done here and it ties nicely. And I know you may not believe it, but I just did a quick and dirty calculation in my head to make sure that the reconciliation numbers match. Because sometimes these numbers end up transposing. So you want to make sure that those are properly done. And then now, so that means I'm going to have 2 K1s coming over from the S Corp and the multi-member LLC into this return. So just looking, they had a salary increase. We want to know where that salary increase came. The person, they got a bonus. That's good. They had retirement distributions last year. They don't have that this year. And now they're retired. So one of the strategies that now we want to look at is because they are now retired, and the reason I know they're retired is because they're collecting, no, not retired, but they started collecting Social Security benefits. We want to make sure that this person does retirement planning. So one of the questions that we're going to ask them is whether they've done their retirement planning. They have a liability, a huge liability. So we need to figure out what is causing that liability. And so because they have a liability, we are going to request an appointment to review their final numbers. So that's it in a nutshell. In terms of what I've looked at today, I will finish up the review of the return, but we are now at 4 p.m. Does anybody have any other questions before we finalize? Again, we're having this meeting every week for the next 4 weeks. And if you have not already scheduled your one-on-one meeting, please make sure that you fill out we sent you a link to get that filled out for those that are in the wealth building program. For those that are not, if you want to, we charge $4.99 for the business meeting. So if it's something, but we're only offering it really to those in the wealth building program. But if you're not and you want to take advantage of it, it's $4.99. All right. Any additional questions before we wrap up for today? All right, so in the absence of any other questions, thank you guys for coming on.